Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 19th of June 2021 and we're asking, did the Fed FOMC make a mistake this past week, resulting in equity markets falling considerably and gold and silver prices crashing? Let's take a look and find out. Well, yesterday Bloomberg came out with quite an interesting article that we thought we would cover today. The Federal Reserve, or the FOMC part of the Federal Reserve, announced last Wednesday that it was going to continue with its $120 billion a month bond buying program, but they will be holding discussions on when to taper that program and suggested it could be very soon. They also highlighted the fact that the majority of board members were in favour of raising interest rates in 2023 at least twice, and some board members favouring one raise in 2022, far earlier than many expected, but not surprising in view of the fact that inflation is currently running in the US at 5% on an annual basis. The Fed's rather hawkish approach, as many have called it, though we didn't actually think it was that hawkish, but nevertheless, that relatively hawkish approach seemed to have spooked markets. And we've seen equity markets fall, the dollar spot index rise nearly 2 points, not quite that high, but not far off when you compare as to what it stood at only 2 weeks ago, and at the same time had a devastating effect on gold and silver prices. So the article, did the Fed just get talked into making a mistake? We thought, let's take a look as to the content of this and run through it. Today's agenda: maybe the Fed got rattled. America's losing too many young adults. Maybe a partisan infrastructure bill won't work. And California and Texas, one bad thing in common. So, Fed wilts before curtain of distraction. We'll read it and then comment. It stinks sitting behind the backboard at a basketball game, but at least you get the perk of being able to distract the opposing team's free throw shooters. It's low-risk fun, with a higher payout rate than trying to make the soldiers laugh at Buckingham Palace. Well, we can account for that for sure, having been to Buckingham Palace a number of times, especially when professionals get involved, like those handling Arizona State's infamous curtain of distraction. The Federal Reserve is inured to razzing from the cheap seats, but you can't help but wonder if it got just a little rattled by the very serious people yelling at it about inflation, right John authors. This week it bent to its hawkish critics just a little, but rather than cheering, markets are acting as if it made a mistake and downgrading growth bets. Stay focused, Fed. So, with equity prices falling, gold and silver prices falling, the dollar index rising, did the Fed actually make a mistake? Well, let's take a look at this article published the same day. The Fed buys the ECB some taper time. Powell's subtle but significant shift gives Europe a chance to highlight its go slower approach. Policy making for the post-pandemic period has begun. Common sense made a welcome reappearance in the debate over the sudden jump in recovery-induced inflation, when Federal Reserve Chair Jerome Powell acknowledged on Wednesday that there are upside risks to the US central bank's forecasts that aggressive price gains in some sectors will fade away. Though a lot of the recent surges may indeed prove transitory, monetary authorities have to recognize there are perils that may emerge if inflation expectations become entrenched. The big winner here could be the European Central Bank. It now has a clear opportunity to highlight its own slower path compared to the Fed's. The US is now formally talking about when it might taper. With the late, actually that's worth highlighting because we pointed out that we didn't actually think that the announcements were particularly hawkish, because after all, no physical action has been taken, only a promise to talk about potential action. And this article is highlighting that. With the late August Jackson Hole Central Bank Symposium, the likely venue for announcing when it might start reducing its $120 billion per month QE bond buying. When the Fed turns, the rest of the global central banks also shift. Whether slightly ahead or behind, the direction of travel is linked. We are in a global financial world. The Bank of Canada has already started tapering. The Bank of England may decide to get a march on the Fed on August the 5th by further trimming its weekly purchases at a meeting when it assesses its quarterly economic forecasts. Now, we think that's a possibility, but our inflation rate at the moment is only running just above 2%. Now, a lot will depend on how markets are performing at the time, and of course any economic data released between now and the 5th of August. We're not sure that we would taper that soon. We'll know more when the next inflation rate is announced in July. Technically, the ECB could begin to discuss tapering as early as September the 10th's Governing Council meeting. On Thursday, however, its chief economist Philip Lane told Bloomberg TV that it is still premature to talk of reining in its QE bond buying. Powell's subtle but significant shift makes this more believable. The ECB can watch how markets respond to the US central bank's approach, and if there is any repeat of the 2013 taper tantrum that made then Fed Chair Ben Bernanke quickly revert to continuing QE. As Viraj Patel, macro strategist at Vanda Research, tweeted, rolling out Lane post a hawkish Fed yesterday is one of the smartest things they've done in recent months. Clearly communicated that the ECB and Fed are on different paths. Draghi would have been proud. You see, the ECB was always at the back of the pack for when it would tighten policy. The euro area economy was on the verge of recession going into the pandemic. If you recall, we covered this with Germany also in dire straits, often renowned for its financial prudence. And its fiscal stimulus response is only just properly starting. This impression of now is not the right time was strengthened after the dovish June meeting and subsequent action this week to extend bank capital relief. And we raised that in one of our earlier videos this week. We highlighted this by pointing out, in some depth in fact, that this gave them the ability, A, to be more dovish, and B, ensure there's more lending in the economy. In fact, it was the video we produced yesterday evening. Lane also highlighted that a lot more economic data needs to be assessed as the next generation EU €800 billion recovery fund starts to be deployed across the bloc's weaker economies. It makes sense to have real-time information on how sustainable the recovery is before lifting the throttle. The ECB is especially focused on how favourable financing conditions are, hence extending to March 2022 the relief for banks on excluding deposits central banks in calculating leverage ratios. The last thing the ECB wants is to accidentally choke off corporate access to loans during recovery. The other key factor is the strength of the euro. While the Fed's actions have seen the common currency slip below 120 to the dollar, the Governing Council will be monitoring closely to see if its conditions for exporters become less favourable over the summer. There are, of course, risks to the ECB buying time, as the rise in the 10-year German bond yield to a 3-week high illustrates. When US Treasury yields change sharply, so largely does the rest of the world. If the euro area benchmark were to test the zero-yield boundary, it would change the dynamics for all the other EU sovereigns and their companies that trade at a spread premium to it. Keeping bond yields pinned down is just as important as not letting Italian BTP yields soar. The two are umbilically linked, so a rapid yield rise, as was seen globally in February, would likely directly worsen euro area financing conditions, though European bank shares might benefit. Nonetheless, Potential panics aside, the ECB has the Fed to thank for restoring some balance to market expectations on the central bank reaction to inflation concerns. This buys time. Nowhere needs it more than Europe, which has a lot of heavy lifting to do to boost growth that has long lagged the rest of the developed world. So what are we basically making of this? Well, broadly, and this may explain to some extent why Fed Chair Jerome Powell made the announcement and comments that he did. We live in a global economy. Yes, of course, there is competition between countries. But where the financial services market is concerned, there is a high level of competition. But there is also an extremely high level of interdependency. You saw that with the collapse of mortgage-backed securities in 2008. Started in America but permeated throughout the Western world. Why did that happen? Because we trade with one another financial instruments. We rely on one another for each other's currencies. The financial system is incredibly closely interlinked and interdependent. So whilst you have on the political front competition between nations, and on the economic front too, to some degree, a zero-sum game is not the solution. It's a question of all boats rising together in a rising tide, or sailing together on a rising tide, rather than necessarily destroying one of your major competitors who are also one of your major allies. This is really important to bear in mind. So if there is some degree of central bank cooperation, at least at what we call the verbal level, in other words, they're sending out signals, do not be surprised by that. And what this is saying to some degree is that the Fed, by saying what it has said, is starting to strengthen the dollar, which we have seen, which will hold down inflation, but has enabled the EU in particular to actually not invoke harsh tapering measures now and to ride that wave slightly to gain it some form of marginal competitive advantage. You may ask why? Because if their economy rises and improves, they will then become a bigger customer of United States goods and services. And this is why we find this subject so fascinating, because we have to look at the motives behind some of the decisions that are made. Because rest assured, it is very rare, because of the training and because of the nature of the establishment, it is very rare for central bankers to say something from the hip, to say something they've not rehearsed, to say something that they did not intend to say. You very rarely find them on Twitter making remarks after a few pints of beer. That's it for now. Our overall conclusion is we do not think the Fed made a mistake, though short term it is having an effect on its equity markets, and fortunately for holders of gold and silver, it's having an effect on that too. And we've seen cryptocurrencies as well fall partially as a result. A lot of these things will recover, certainly over the months ahead, until actual action takes place. And even then, so much of it will have been built in, perhaps the response will not be as dramatic as many feared. So in terms of gold and silver, we may have some testing times ahead as the dollar strengthens slightly, particularly while some of our European competitors, or America's European competitors, because we're technically in Europe, although not in the EU, here in the UK, they actually have a slight advantage by allowing QE to go ahead longer than what may happen in the United States. That said, if our inflation figures change over the next month or so, then we may taper first. Who knows? Let's wait and see. But the road for gold and silver will be a little rocky for the next month or so. But we'll know more in the next couple of weeks. Hope this is useful. No point going on any further. Thank you for listening. Please like, share, and comment on our videos. And if you have subscribed, make sure you've pressed the bell sign so you're notified of new ones as and when they are published. And a final reminder, earlier today we produced a very lengthy gold and silver weekly update, and we place a link to that in the description box below and also at the top of the comment section. Thank you for listening. Until next time. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.